Hi, Paul. Thank you for taking it. Actually, two questions. The first is, could you identify any trends, pain points, or challenges, I guess, other than AI that's really driving some opportunities in the industry? And then the second question is, I love your picture, and I was thinking, like, what don't I see there? And I just assumed that banks like yours would probably have competitors that would be like internet banks or credit unions, or could you just maybe cover that a little bit if you can?
Sure. So let me start with trends. Um, technology. As we have grown as a bank, um, I'm given more and more tools that help make a process simpler. From my perspective, it's a commercial lending process simpler. We're getting more technology, so document collection is automated. That's one big thing. There's some AI getting used in that, I will say. Um, but most banks are leery of AI as well because of the privacy concerns. Um, who's getting access to that data? Um, how is it being used? How secure is it? I mean, you can just go on, any newspaper and look up banks that have had issues with data breaches. Fraud is extremely on the rise, and there is a concern of how secure are these AI tools, like any tool we would use, if we're integrating it into sometimes an archaic system. Similar to if you look up airlines, a lot of banking software is not cutting edge. It's being built on older systems. And there's pros and cons to that. Um, we at the size we are currently, we're never the first mover in technology. A Chase Bank, for example, is probably and Capital One, and I would argue Capital One's more of a tech firm than a bank. They're really a credit card company at their heart, even though they are technically a bank. And I have them on here of list of competitors. We're doing very different things. They're investing a ton of money into technology, and it for that top tier of banking, quote unquote, at that level, it's an arms race. And that doesn't mean they're frankly deploying capital successfully with that amount of investment. The nice part for us is we're in a position as a medium regional sized bank that we get the hand me downs, but we're not having to pay so much for the R&D for it. So every bank has, a Zelle feature. Every bank has, frankly, treasury services that allow you to take mobile deposit. All these different features are out there. It's very expensive to make those, but it's a lot less expensive to be the second or third adapter with it. So technology is definitely driving a lot of bank consolidation. I actually I did a thesis as part of my undergrad on why are banks being consolidated. We can go into that at a different time, but um, there are fewer banks now because of bank consolidation. The other big piece that's driving some of that consolidation is regulatory pressure. It is extremely expensive, especially post '08, to be in that $10 billion range. Most banks have to jump from, that 8 billion to 13 to 15 billion very quickly. Otherwise, the expenses just outweigh the benefits of growing slowly. So consolidation is always on the table for those banks trying to get over that hurdle. And then there's economies of scale at that point. Um, I want to pause. Those are some trends. One final one I'll talk about that's just very specific to now. Um, and I think everyone's trying to figure out what to do with it, but it's commercial office. And that's I could do a whole presentation on just commercial office right now. Um, but there's obviously, especially in urban markets, oversaturation, oversupply of office. And with work from home, us doing this virtually, um, it has changed the game with that specific type of commercial real estate asset. Especially if it's um, older commercial real estate. It's not recently renovated. There's still Class A, which, everybody's there are always going to be demand for some of these fancy new office buildings. But as they grow in age, as they deteriorate, these asset classes are getting a lot more competition. For my practice, it's actually benefited in I've benefited in some ways because I work with a lot of owner users as opposed to large investors. A lot of my owner users, medical practitioners, lawyers, CPAs, they were previously leasing and probably could never have afforded to buy the office because there were all these larger companies out there and investors. Now they are able to afford office and build out their practice in a way from a structural standpoint of a better customer experience. They're not just adapting the space, they are making the space suit the needs of that clientele. Um, I can dive into that more if people want to talk about commercial office. Every bank's dealing with it in some way or another. And for example, the DC market is very different issues than out in Warrenton or Middleburg for office. So it is somewhat location specific. Those are the big trends I'll talk about right now. The second part of your question, other types of competitors. Again, Capital One is a bank. Their incentives are different. Their credit card portfolio is the heart of what they do. They have business lenders like myself, but really they're deposit gatherers. And if I'm making loans at 6% right now for owner occupied, their credit cards, if you're lucky, are 12 to 20s. It's a different risk versus return for them. They do a lot more, in my opinion, in data analytics than, frankly, most larger than us scaled banks. The credit unions, I'm biased because I work for a bank. The definition of what a member has very much changed over time, and a lot of them, they're frankly are not barriers to joining, just like there aren't barriers to joining a bank. That was not always the case. You used to have to work for a specific employer to become a part of that credit union or reside in a specific zip code. A lot of them now, and I know this from friends who work at credit unions, you can become a part of a credit union by going to a certain church, even if you don't stay with that church for a long period of time. You can join that credit union if you happen to work in a certain area, even if it's not for a specific employer or you don't live there. Just the definition of what a member is has gotten a lot bigger. They do, quote unquote, return money to their shareholders, which are the employees and the depositors. It's a different model. They are not regulated the same way, to date at least. They have a different type of insurance. We're FDIC. They have their own credit union specific insurance. So there's different regulation involved there. And finally, I see you're unmuted, but my final point that I'm going to touch on is the online banks. There are some people, there are apps out there that will, refund your deposit from work a day early, and they're really giving you a loan, things like that. There were a lot of tech companies that were offering, frankly, absurdly low unsecured loans to people based on data from our smartphones, things of that nature. Some of that's worked out, some of that hasn't. Again, I do stand by, you have to embrace the technology. Everyone wants more technology, but that's just the playing stakes at this point. Having a decent mobile app you can't run a bank anymore without having a decent mobile app. There is still a demand for people like myself, for branch managers, for the financial service advisors, because people do still want to have that conversation and understand the process of banking, in my opinion.
Yeah,
So
I
that,
was going to ask about that. There's just sort of changing customer demographics as you get more people who are younger, and they grew up on the internet. And the reason why I asked is I was telling my sister, my younger sister, I was joining this. I was looking forward to this particular presentation, and she reminded me she's 29. She's only been in a bank other than an ATM 3 times in her entire life. like gone into a bank. And it like stunned me. And then I really thought about it and I go, yeah, that makes sense.
So there's a, and we can dive into a bunch of different groups. I will say on the commercial side, far heavier in-person traffic than the consumer side from what we're seeing, just demographics wise. At the same token, I've had clients in Maryland who have never stepped foot into a bank because it was an hour away. Why would they drive an hour? What are they doing? They're calling me directly. They have my cell phone. We're leveraging technology that's out there. Um, and as people, especially post COVID, people have gotten used to this kind of technology, DocuSign, Zoom. Before COVID, probably 80% of my clients couldn't figure out how to get on the Zoom. Now they've had to embrace it, and really just their mindset changed. It's they wanted to embrace it because they wanted to keep doing business. They wanted to talk to their family members without being in the room. So there was an extra push that got us all there. Um, I will say and this is, I'm not diving the data right now, which is always dangerous, but from my experience, um, I work with people at all different age demographics, different backgrounds. I think some of this technology is helping communities that are normally underserved. So there are definitely, um, low income to moderate income areas that, frankly, banking is not the norm. Having a bank account is not expected. Um, and there's actually dangers of, predatory lending. There's dangers of overdraft fees that outweigh, eventually drain your bank account to the point where your entire paycheck is going to fees. So there's a lot of issues out there that technology is helping address. Um, I mean, when my father was going through med school, you almost always got a check in hand when you left the day. That's why banks on Fridays were such a crazy place. Now it's just automatically deposited. Um, it's a different landscape. Um, I also, as part of the bank, I'm part of a division, in addition to my normal work, which is part of our women and minority business owner division. So I've specifically helped trying to bring communities that have not historically been a focus of banks into our bank. Explain how we can help them, provide additional incentives, and provide additional education about the benefits of banking. Um, Technology is helping a lot with that. Um, is there a certain area you want me to dive into, Tammy? I'm happy to go a couple different areas.
No, I just always see, sometimes opportunity and challenges and chaos, you know what I mean? And that's kind of where, the growth and the hiring will probably be.
And again, this is anecdotal, not based on data, but I know we have financial advisors, which is different than a financial service advisor. Financial advisors are typically Series 7 based. They're investing in the stock market on behalf of their clients. They're providing a fiduciary responsibility in terms of investing in retirement planning. A lot of the people who I work with in that field, they have clients who it's not their first transaction anymore. They went and bought crypto. They went and bought stock. There's a lot of these brokerages now that are online that it's free trades, or minimal fees that especially compared to what it used to be to do so. Um, However, they are still busy because when the markets turn, when everyone goes from making money to people lose money, people all of a sudden who were doing it themselves realize, maybe it was difficult juggling a 9 to 5 and managing my brokerage account. Um, there's a lot more emotion involved in that trading, and people at a certain point don't look for how to do it; they look for who can do it for me. Um, Not everybody's like that. Some people just actually enjoy studying the markets and investing. Um, I don't think everybody's like that though. And sometimes it's easier to hire a professional who, yes, you're paying them a fee, but hopefully they're providing a return on that fee, an additional service than you could do just researching it on your own.